Hello, this is Brian Rezny, President of Rezny Wealth Management and host of the Rezny Wealth Report. We're here live every Wednesday at 6 p.m. and we do replay on Sunday evenings at 7:30. And of course, we've got our website at the bottom of the screen and we will be taking calls. When you call that number, our studio producer will take your call and relay it back to me and I'll answer your question on TV. So you don't actually have to be on TV, but I'll make sure you get the right answer about your portfolio. We've been getting just a tremendous amount of calls into our offices throughout Florida, Fort Myers, and in Naples here. Investors that listen to my TV and my radio show routinely. And a lot of these investors are very nervous about, is the stock market high? Are we going to get a correction? What about the bond market falling apart? What about what happened in real estate in 2007, 8, and 9 as that fell apart? A lot of investors are really questioning the investment advice they're getting. And more importantly, they're questioning a buy and hold or a set it and forget it mentality. A lot of investors, because they work with a lot of these Wall Street firms or firms that basically do what's called passive investing, you know that pie-shaped chart investing that you see on your brokerage statement? That's where you buy stock or bond-related investments and it basically fills up that pie chart. And it's kind of set it and forget it. We have a lot of people calling our offices saying, Brian, if we have another correction, what are you telling your clients on your radio and TV show? How do you protect against severe down markets? Is an active strategy better than a passive strategy? I firmly believe so. In fact, I'm going to talk a lot today about our investment strategy at Rezny Wealth Management, while I feel it is completely superior to a buy and hold, an asset allocation approach, which has been ineffective not only in 2000, but in 2008. Passive investing is a failed investing approach. Too many investors get lulled into thinking diversifying their portfolio and holding assets that are going down for prolonged periods of time is a strategy. Unfortunately, a lot of these firms, all they're really doing is asset gathering your money. You basically come there, they put you in this pie-shaped allocation, and they give you something that looks like this, something that's stock and bond related. What I find too often with investors is this: when you buy into that pie-shaped chart, the problem is this: if you own stock and bond-related investments, almost 90% of the people that come into my firm and hire us every single day, every single month, and every single year have one of these pie charts. They come from a so-called advisor, a Wall Street company, or some financial planning firm. The pie charts are always similar. They have either stock or bond-related investments. They might be bond mutual funds or equity mutual funds, but it's basically this 60-40 split or 50-50 or maybe 100% on either side. The problem is, if you even did a 50-50 split, meaning stock-related and equity-related or stock-related investments, the problem you have is this: you're going to own half of that magic pie chart they keep telling you that's going down in a severe down market. In 2000, asset allocation failed you, the investor. In 2008, it failed you again. Ask yourself, did that pie-shaped false diversification, that set it and forget it, work in your portfolio in either one of those two last recessions? Statistically speaking, we have recessions almost every 6 to 7 years. We're long overdue for another recession after 2008. It might be another year from now, it could be a month from now, it could be 5 years from now. But at the end of the day, if you own risk assets like the stock market and we go into recession, statistically the stock market's gone down 30 to 50% out of the last 7 or 8 recessions we've had. The last 2 recessions, the market went down over 50%. Can you afford to hold on to a set it and forget it false asset allocation approach that you think is diversifying you, but those assets are going down? Probably not. The problem most investors face, and at least the people that call my firm to manage their money, is simple. They want to make a return on their money, but they want to protect against major catastrophic loss of their portfolio. The kind of losses investors saw in 2000 and in 2008. I'm going to talk about relative strength investing, an approach that we use in all of our client managed accounts. It's active, it's adaptive, and it's objective. And I think too many investors fall prey to buy and hold, set it and forget it, ineffective investment strategies that are outdated and they're unwarranted in your retirement account. Let's talk a little bit about what asset allocation is. They tell you, let's buy 2 sectors or 10 sectors or 20 sectors. The problem with typical asset allocation is this. If you buy only 2 sectors and it's stock or bond related and stocks go down, half your money goes down. If, like on my last chart I showed you, had 20 sectors, 20 different investments. The problem with that is if you own everything, does that mean everything should be doing well all the time? What you're told with asset allocation is, well, since the firm doesn't really know what's going on, in my opinion, that's what happens to too many of you investors. They tell you, well, we're not sure what's going to do well. So what we're going to do is we're going to buy a bunch of everything. So let's assume in my last chart that half of those investments are appropriate and they're relatively strong and going up, and the other half of those 20 investments are wrong for today's economic scenario, and you continue to hold those as they either go down in value or they have mediocre performance. What's that going to do to your portfolio? It's going to water down the results. So the bottom line is this. Diversification is important, but it's how you diversify that portfolio and what asset categories you ultimately pick for your portfolio. Just using pie-shaped asset allocation, a set-it-and-forget-it mentality, hasn't worked in the last 2 market corrections, and I firmly believe investors that follow that failed approach are going to lose another 30 or 50% of your portfolio. We consistently have investors who are frustrated with lackluster performance because they made money, they said, but then they gave it all back and more when we went in a recession. The key is making a return on your money, but if you don't have a way to mitigate risk in major recessions, meaning you keep holding all assets, you're going to ride them all the way back down, and unfortunately, many investors still haven't recovered what they lost from a few years back. I think, again, asset allocation, a set-it-and-forget-it passive approach, is old school, it doesn't work, it's ineffective, and investors that follow it are taking more risk than they realize. Let's talk about why asset allocation doesn't work. Your wife decides to make a bowl of soup for you for dinner. You know as an investor, the best utensil in the drawer to use is a spoon. So she puts a bowl of soup in front of you. She gives you a soup spoon. You know that you can effectively eat that soup. What if your wife took the box or the drawer of utensils and put those in front of you, all the utensils in the drawer, and said, hey, by the way, that bowl of soup that I gave you, I want you to eat that soup with each one of the utensils in the drawer evenly. You wouldn't be effective eating soup using a fork or a knife or a gravy ladle. Of course not. But if you think about asset allocation, you own the good with the bad. Why would you do that to your portfolio? Asset allocation is like trying to eat a bowl of soup with something rather than a soup spoon, which would be the appropriate item or utensil in the drawer. I think too many investors, again, fail at investing because the approach that they're given is some standard, outdated approach of passive investing, a buy and hold, a couple asset categories, and you ride it all the way down. I'm going to take a short break. When I come back, I'm going to talk more about why asset allocation is a failed approach, why relative strength investing, moving throughout different market sectors, is a much better way to grow and protect your money. I'll be right back with your calls and your questions after this. Hi, I'm Brian Rezny. If you're like many investors, you've lost a lot of your retirement assets due to poor investment management or being sold investments that are often better for that so-called advisor than you. Most so-called advisors are just salespeople or brokers for investments their firms represent. No real advice at all. If you're tired of bad investment advice and are ready for positive change for your retirement, call my firm for a consultation. Don't settle for bad investment advice. There is a difference. Call us today. Hi everyone, this is Brian Rezny. I'm back with today's program. We're talking about a failed investment approach, which is asset allocation. You know that pie-shaped chart that Wall Street keeps trying to push on you, the investor. I'm sorry to tell you folks, asset allocation is a flawed approach. It's failed twice in 2 years or in the last 2 recessions. Investors that followed that approach haven't fared very well. Set it and forget it doesn't work in any economy, in my opinion. You need to be a proactive investor that moves their assets around when appropriate change is warranted. I'm going to talk about what works better than passive investing, passive asset allocation. It's called relative strength. Relatively stronger investment sectors historically have outperformed. We call it the fastest horse. Relatively weaker investment sectors historically have underperformed the slowest horse. Think about investing this way. If you go to a horse race and you're going to race one of your horses, do you race your slowest horse or do you race your fastest horse if you want to have a chance to win the race? Exactly. The fastest horse you're going to race because he has a better chance of winning the race. But if you think about asset allocation, if you have assets that are weak or slow and you keep those in your portfolio, what's that going to do to the return of the good assets that are fast or strong? It's going to water them down. So ultimately, think about what happened in 2008. In 2008, equities in general dropped about 50% in value. They didn't drop immediately 50%. It took 15 months for the equity markets to bottom out at over a 50% drop for most investors. They got weaker and weaker and weaker. In fact, most asset categories, not just stocks, bonds, real estate, gold, it doesn't matter, typically run in patterns of relative strength and relative weakness. Think about your portfolio like a horse race. You want to own relatively stronger asset categories in your portfolio, and you want to sell weaker categories or assets in your portfolio, and you want to repeat that process. Weaker investments historically have gone down in value. Let me talk about a little bit about why weak assets hurt your portfolio. Statistically speaking, are you better off buying stocks or a basket of stocks at 52-week highs, or are you better off buying baskets of stocks at 52-week lows? Actually, statistically speaking, there's been many studies on this, you're better off buying stocks, a basket of them, and holding those for 12 months at 52-week highs. They're relatively stronger. Buying assets that are in a downtrend, which I've talked about repeatedly on my TV and my radio show, is a recipe for mediocre returns and underperformance and bigger risk. Relatively stronger assets outperform, we call it the fastest horse or wins the race. You as an investor can do one of two things. You can keep buying assets going down or that are relatively weak, or hold on to a buy and hold portfolio that becomes weaker and weaker and weaker, or you can look at changing your portfolio style to owning assets that are relatively strong and trending up. There's different ways that you can rank relative strength, but essentially what you're doing is you're looking at a broad-based category of assets, not just stocks and not just bonds. When I showed you that pie-shaped chart earlier in my program, I talked about most investors. In fact, about 90% of the investors that come in and hire my firm to manage their money come in with a standard asset allocation. They have stock or bond-related mutual funds in their portfolio, and it's almost always just in the U.S. And I always ask the couple or the person they came in, I said, what about all the other asset categories around the world? How come you don't have any of those included in your portfolio? What they tell me is, well, that's what our advisor showed us. And again, most of these advisors are not really money managers. In fact, about 90% of investors are probably working with a broker that uses a title to basically think they do more than they do. They basically asset gather your money, they put it in a pie-shaped allocation, and it's set it and forget it. Ask yourself a question. Did your advisor call you in 2000 and tell you needed to change your portfolio when things started going down or getting relatively weak? Or did you buy and hold all the way down? Did your advisor call you again in 2008 and advise you it's time to start selling equities because they're getting relative weak? Did you? Did he or did she? Probably not. At the end of the day, relative weakness usually brings more relative weakness and underperformance, and relative strength traditionally brings more relative strength until that trend changes. What we do at Rezny Wealth Management, we use a proprietary relative strength ranking system. Number one, your strategy and our strategy needs to be objective. And number two, it has to be adaptive. Let me talk about what hurts a lot of you investors out there. Emotions. Because your emotions are basically making your investment decisions, and because that so-called advisor is actually not acting in a money manager capacity, you're left on your own. So what happens to a lot of investors when assets start going down or your investments start going down, you usually panic and you maybe sell then at the wrong time, or you move into the wrong investment at the wrong time. Your strategy isn't objective. It has to be rules-based, and it's got to be completely objective based upon the rules and parameters of your actual strategy. It has to be adaptive, and this is one of the things where the rubber hits the road, and I try to teach all investors that when they come into our office and hire a firm. If your investment strategy is one-dimensional or one-sided, meaning you're always in the equity market or you're always in the bond market and equity market, that's one-dimensional. You're always going to be in equities, even all the way down when sometimes they go down for 12 or 15 months in a row. That's a mistake. Your portfolio needs to be adaptive. There's times you want to move your portfolio out of equities and into more safe assets like short-term treasuries, maybe gold, maybe cash. At the end of the day, owning one or two asset categories in this fake pie chart, hoping that some of those things do well over a period of time, gives you false sense of security, and bottom line, it hasn't worked for you, the investor. Again, go back to 2000, go back to 2008, did passive asset allocation, buy and hold a couple different categories in your portfolio, help save your portfolio from catastrophic loss? Probably not, because the portfolio wasn't adaptive and you didn't migrate out of risk assets as they got relatively weak, either in 2000 or in 2008. This is a great picture chart that we put together, and it really not only talks about our investment strategy, but how you should think about investing. Your portfolio shouldn't just look at stocks and bonds, it should look at all assets. So we kind of talk about a horse race, and I've done that repeatedly through this program. Basically, if you want to win a horse race, you have to race your fastest horse. So what we want is a stable of horses. Those would represent all kinds of asset classes, not just stocks and bonds. What we want to do is rank those categories on relative strength, and we want to own the top categories in a client portfolio. Think about this. Just like eating a bowl of soup, you'd pull out the utensil drawer, you'd pull out a soup spoon to eat soup. If the next night you had bread, butter, a salad, a baked potato, and a steak, you would pull out different utensils out of that drawer to use. So what you want as an investor is don't be one-sided. Don't let your advisor just show you stocks and bonds or 20 stock and bond mutual funds and 20 equity funds. That, again, isn't diversification. It's just overlap. What you want to do is look at all asset categories, things like gold, oil, currency, inverse ETFs, all the different aspects of bonds and government bonds and emerging market bonds, small, large cap, real estate, all these different categories that most people don't look at because you're not familiar with them, so you're sold stock or bond asset allocation. By doing a broad-based stable of investments that you're picking, that's where you can pick from. So all of those assets are in your viewing arena. You don't own them all. What you want to do is you want to own those assets that are relatively stronger and in an uptrend. Sometimes that means going to cash. Sometimes that means adding conservative investments. Sometimes coming back out of a recession like in 2009, it would have put you more into the areas you wanted to be in, which were equities started getting relatively strong again after a 15-month decline. Bottom line is this, folks. Adaptive, relative strength investing not only can help you grow your portfolio, but it'll give you actual risk management without emotional when to buy and when to sell pivot points. I'm going to take a short break. I'm lining up a few phone calls with questions right now. I'll be back right after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Do you know the biggest risks to your retirement and investments? One is entrusting your hard-earned money to someone who doesn't work in your best interest. The other is a lack of a detailed investment strategy to meet your goals. Both risks can be devastating, but both can be corrected. Rezny Wealth Management, fee-only money management. Don't settle for questionable investment advice. Call my firm for a consultation. There is a difference. Hello, this is Brian Rezny, President of Rezny Wealth Management and Chief Investment Officer, and of course, the host of the Rezny Wealth Report. We're live here every Wednesday. We rebroadcast on Sunday at 7:30. And of course, you can listen to my live radio show throughout Florida every Sunday from 10 to noon. Better yet, visit my website, ReznyWealth.com. In fact, you can read about our investment strategy. We talk more about relative strength investing, why we feel it's superior because it's objective, it's adaptive, and risk management is an important part of how we manage money. So instead of buying and holding or having an ineffective asset allocation, set it and forget it approach that you keep hearing from your advisor, hold on, things will come back. It didn't work in 2000, it didn't work in 2008, and if we do get another recession, it's probably not going to work again. You need a strategy that helps you mitigate risk and reduce risk in severe down markets. And relative strength investing will help you be more adaptive to your portfolio. I'm going to go to a few phone calls, but before I do, if you want to call my firm for a consultation, we do have offices throughout Florida and in Naples and Fort Myers. If you'd like to call my firm, look at the number at the bottom of the screen. You can also visit our website for more information about our management. We are a fee-only money management firm. We have a legal obligation to work in our clients' best interest as a fiduciary. And by the way, don't think most firms actually work in a fiduciary capacity. In fact, it's probably less than 10% do. And most firms don't actually manage money. They sell investments because they're Wall Street brokers. At the end of the day, a real investment strategy, which includes risk management, is going to be important for your retirement. Give us a call, set up a consultation. I always tell investors, there's a big difference. We invite you to experience it. My first caller, Cliff at Marco Island. Do you think we're headed for a correction? Cliff, this is what I would tell you. I don't know if we're going to have a correction today, a year from now, or 5 years from now. What I'm going to tell you is this. We will get another correction. I just don't know when. Anybody that tells you when is mistaken. I call it bubble vision on a lot of these shows on TV where all they talk about is where the market's going today, tomorrow, and next week. That's not a strategy. What I'm going to tell you is this. Relative strength investing, what I'm talking about today and trying to educate our TV listeners is simple. It's a simple approach. It's an effective approach, but more importantly, it helps reduce risk. In a correction, the markets historically don't just drop 30, 40, or 50%. They typically get weaker over a period of time. On average, in the average recession, it takes between 12 and 18 months for the markets to bottom out. They get weaker and weaker and weaker. So by using a relative strength strategy in your portfolio, it will help you start alleviating the risk in the portfolio as equities start rolling over. By the way, it's going to work equally as well when we start to see interest rates eventually go up and bond values drop like a rock. Remember, bonds are not safe investments, folks, especially at low interest rates. They can go down just like equities can go down in real estate and every other asset. The key is avoid weak assets going down and own relatively strong assets in an uptrend. Cliff, I hope that answers your question. If you're like Cliff and you have a question about your portfolio, our number's at the bottom of the screen. Phil in Naples. Brian, you have a great show. I'm with an advisor who buys only large cap stocks. I lost 50% in 2008 as we rode it all the way down. I'm nervous and I don't want to repeat it. Phil, you're like a lot of people that hire my firm to manage their money. The problem is your advisor, if all he's doing is buying large cap U.S. equities, that is so one-sided. Think about it. What about all the other investment categories in the world? So what it sounds like is you have a money management firm that only manages individual stocks, and they're all large cap. So what about all the other great areas to invest in? Or what about when equities are not appropriate? The reason you wrote it down back in 2008 is because most equity managers own and they don't have a reason why they're going to sell, meaning they don't have decisive risk management. Think about the mutual funds you might have owned. Most mutual fund managers in their mandate are always invested. So that means even though the markets may be going down, they're still telling their investors, buy, buy, buy. Remember, Wall Street is not your friend. They don't effectively manage your money. That's been proven multiple times. At the end of the day, buy and hold is only going to get you into trouble. You want to have a strategy that's going to help you mitigate major catastrophic losses like what you saw in the past. What I would say to you is call my office for a consultation. You would be greatly improved by the way that we manage portfolios. You'll get a great education by sitting down with us, and you'll realize there's a big difference by using multiple asset categories, not being one-sided or one dimension, and that's exactly, unfortunately, what I think you're seeing right now with your current advisor. Mike in Naples. Let's see, the firm I use is more buy and hold asset allocation. I asked my advisor, how do they manage risk? He said they don't. It looks like they basically hold on. What should I do? Oh, Mike, great question. We get a lot of these comments all the time. Most firms, when they're looking at asset allocation, the approach behind asset allocation, or the flawed approach, I should say, is you're going to diversify that portfolio. So unfortunately, some of those assets are going to go down and some assets will go up. The problem is, why would you own assets on a prolonged period of time that are going down? It's going to water down the return of the good assets that are actually trending up. A buy and hold approach, set it and forget it asset allocation, which I've been talking a lot about during this show, is really a failed approach. It hasn't worked in the last couple market corrections, and it's not going to work in the next one. That's a problem. Dan in Fort Myers, I have a problem. The problem is I'm an emotional investor and I don't like the roller coaster like you discussed. How does an investor know when to sell? If you're an emotional investor, you should hire a real advisory firm which includes risk management. At the end of the day, emotions are going to get you into trouble. That has to be taken completely out of your investment strategy. Unfortunately, if you don't have a strategy in writing, if you don't follow that strategy, that discipline, or you don't have the discipline to follow an investment strategy, you're going to screw your portfolio. I see this a lot. Clients that often hire our firm hire us because they tell me, Brian, I just don't have the discipline or the education to do this. It's not as easy as I thought it was. I need a firm that actually is going to manage my money so it has upside potential, but more importantly, will manage the risk in severe down markets. Folks, I hope you enjoyed today's show. I hope you learned a lot. Please visit my website, reznywealth.com. Better yet, call us for a consultation. You would benefit from a consultation if you're realizing you've ridden two markets down in 2000 and 2008. You realize that passive investing, buy and hold asset allocation, hasn't worked for you, and it's probably not going to work in the future. You've lost money in 2000 and 2008, and you don't want to repeat those issues again. Call my firm for a consultation. If you're looking for active money management, which includes risk management, there is a difference. We invite you to experience it. Visit our website and call our office at 800-618-8577. Have a profitable week.